Hello, I'm Kevin Ball from FX Trading Company, and I'd like to take another look at the US dollar. If we look at the first chart, which is a chart we looked at last on the 14th of November 2019, a B wave high had been identified on the 4th of October 2019, with the E wave creating its own ending diagonal 5-wave structure. Now, the comment throwover times 4 was also added in October 2019. It highlighted a bearish US dollar. This chart included a 1-2 with anticipated declines. Now, if the labeling was correct, it would be a mathematical requirement for the US dollar to decline from this point. Now, does that mean that the future is already set? Well, yes and no, but how far and how fast and how complex the decline will be remains to be seen. We can anticipate the decline, but its structure will be unique, although at this position in the market, it will contain 5 waves. Now, just a point to consider is that Elliott wave principle is 88 years old, and when discovered, there were no computers, no algorithms, no high-frequency trading, and yet financial markets still produce what can only be described as a reoccurring phenomenon. If we look at the second chart, which is the US dollar captured just yesterday on the 13th of January 2020, 7 more weeks have passed with further declines. It was stated on the 14th of November 2019 that it was not unreasonable to label the chart with a 1-2 decline, while a possible further 1-2 could also be added under the wave principle as a count, identifying a possible extending third wave as a possibility. So let's just recap. All the data above in the chart that you're looking at since August 2018 to now is simply correcting what is in the red box on the left, which contains the first impulse wave of 5 to the upside or a new bull market advance. But remember, the correction isn't over yet and further declines are expected. If we look at our third and final chart, it is again of the US dollar, but with more data on a weekly basis. And on the left, at the top left, you'll see a red 3, and again in the middle under the red box is a red 4. The data in the middle of these 2 points is an expanded flat correction under the Elliott wave principle. This correction lasted 36 months. The advance that it was correcting lasted only 11 months. And our first impulse wave in the red box lasted 7 months. Now, the correction since the completion of that first impulse wave in the red box is 17 months. So you can see that markets spend far longer correcting than they do advancing. The current labeling remains with the expectation that the US dollar could decline to the blue and magenta coloured trend lines at 92.63 and 91.66, which you can see on this chart, being the 50 and 61.8% retracement of the prior advance, which again, just to remind people, in this case is the data in the red box. Now, if that is seen, the US dollar would be very bullish indeed for many months. So we will continue to watch and update and see how the position unfolds and look for those declines in the US dollar and then see how the structure looks.